Hello everyone. Welcome to Zylostar Forex Education. Zylostar Forex Education is a Dubai-based institution which is approved by Dubai government. My name is Aishwarya Sharma and today's session's topic is Introduction to Financial Market. In today's session, we are going to learn about some of the basics of the financial market and different segments of the financial markets. So let's start today's session without wasting any time. Now, let me throw some lights on the courses offered by Zylostar. Currently, we are having three major courses in which we have beginner's course, premium course and advanced course, where beginner's course is free of cost course and some of the details of the beginner's course you can see on your screen. Then we have our premium course which will cost you 2500 AED, where you will be getting 7 sessions and each session will be there for 1.5 hours. And again the details are there on your screen. Then we have our advanced course, it costs you 4000 AED and again each session will be there for 1.5 hours. Some more details about the advanced course are there on your screen. Now let me tell you some of the top services offered by Zylostar. Number 1. Trading account with the raw spreads and zero commission with a highly regulated brokers. Number 2. Free third-party signal service subscription worth $500 per month. So this third-party signal subscription you will be getting for 2 months. So fortunately you will be getting 1000 worth subscription for free of cost from Zylostar. Then we have free Zylostar indicator strategy. So it is an indicator strategy which will help you to grow in your trading career. Number 4. We have free 5 sessions in the basics forex education. So it means Zylostar provide you 5 sessions free of cost for your basic forex education. Number 5, we have copy the Zylostar strategy via copy trading platform when you choose not to trade manually. It means if you don't have time, you don't have enough time to trade by yourself, in that case you can copy our strategies and automatically the trades will be copied to your account, which will help you to grow your money without even investing your time. Number 6. Free financial updates through our social media accounts, websites and emails. So you will be getting the access to all the social media accounts of Zylostar where you will be getting each and every update about the market. Number 7. Daily analysis charts updates through Zylostar website, TradingView, Forex Factory, Investing.com, BabyWebs.com and MyFXBook. It means we are available on all these platforms and we give our daily technical analysis updates on all these platforms. Number 8. Weekly group masterclass where everyone can share experiences related to the financial markets and clarify doubts from the Zylostar experts. It means in a week there will be a masterclass which will be held in Zylostar premises and you can visit, you can attend that class and whatever the doubts you have regarding the market, you can clear all your doubts and with that additional knowledge will be given to you in this masterclass. So these were the top services offered by Zylostar. After knowing about the services offered by Zylostar, now let's start our session. The very first term which comes into our mind is trading. Now let me simplify the trading in just one sentence. A process of buying and selling is known as trading. So whenever in any business the process of buying and selling is being done, it means that business is a trading business. Now trading can be done in any product or in any service. It can be done in stationeries, electronics, shares, stocks, forex, anything. But in our session we are going to talk about the financial market. So we are going to focus mostly on the financial market and the different type of segments which are there under the financial market. Now let's take an example of a trader in a general scenario. So for example, let's take an example of a supermarket. Supermarket is not a producer, it is not a consumer, it is just a trader. Why? Because supermarket is buying the products from the wholesaler and selling it to the retail customers. So the supermarket is doing the process of buying and selling, and the business which involves the process of buying and selling is a trading business. That's why supermarket is doing a trading business and supermarket is acting as a trader here. Now, why should we do trading? There is only one reason why we all want to do trading, no matter in what instrument we are doing it, but the purpose of doing trading is just one, that is to earn some profit out of that. Now, how one can earn profit out of this market? Simple, all you need to do is you have to buy at a lower prices and sell at a higher prices. For example, you are doing trading in mobile phones. When you are buying some mobile phone at a price of $1,000 and you are selling the same mobile phone at $1,050, it means you are buying at a price of 1000 and selling at a price of 1050. In this process, you are making $50 in this process. It means now here you are making money. Why? Because you are buying at a lower price and selling at a higher price. Let's understand what is investments and why people always look for the opportunities for the investment in the financial markets. Now, investment is investing your money into some kind of assets or in some kind of plan where you can beat the inflation. Now, what is inflation? Inflation is the increasing cost of the basic necessities. That inflation, if you'll check the government census, sometimes the inflation rate is 5% a year, sometimes it's 6% a year, and it may vary and it can go up to 9 to 10% as well. So that is why people will look for an opportunities where their capital can also grow and can also beat the inflation rate. Because for example, you have a money into your bank account and your bank is giving you 2% interest rate every year. But every year the inflation rate is 10%. In that case, your money is depreciating by 8% per year. Even though you are getting 2% return from the bank, but still, because the same value money can buy 8% lesser products than last year. So it means every year the value of your money is depreciating by 8%. So now to beat this inflation, people find opportunities for the investment in different markets. And this financial market is one of the most attractive market where people prefer to invest. So that is why people always prefer to invest in our financial markets. Now, because we are into the financial markets, so let's understand that what exactly this financial market is. What all segments are there in the financial markets? In our today's session, we use the word financial market. Now, what is the financial market? Financial market is a marketplace where you can buy and sell different financial products. Now, these financial products are divided into 5 major segments. So now let's understand what these 5 major segments are. I'm going to name these 5 major segments and one by one we are going to learn more about these segments. So these segments are commodity market, forex market, stock market, index market and cryptocurrency market. Now let's go through all of these type of markets one by one. First of all, let's talk about commodity market. Commodity market is a marketplace where you can do buying and selling in a natural resources consist of raw materials. Now what is natural resources? So all the resources which we get from nature are the natural resources. I can categorize them into 4 major categories. Here all the metals are there under the metal segments. So metal segments are also divided into 2. The first one is the precious metal. By the name only you will understand the precious metal meaning. So all the metals which are higher in price are under the precious metal, just like gold and silver. Then we have base metals. So by the name only you will understand what is the base metal. All the cheaper metals in the market are under the base metal category, just like copper, lead, zinc, aluminium. So we are familiar with all these type of metals. Now let's come to our third category, which is energy. Now, in energy, all the natural resources from where we get the energy, which are the sources of energy, are under the energy category, just like crude oil, Brent oil, natural gas, coal. Now, what is crude oil and Brent oil? Crude oil and Brent oil are the raw form of petrol and diesel. You know about the natural gas and the coal. So all these are a part of a energy category. Now our fourth category is agro. So all the agricultural products are there under the agro market, just like cotton, coffee, wheat, corn, rice, etc. All these instruments combinedly makes one market, which is a commodity market. So this was an introduction about the commodity market. Now let's talk about the forex market. The foreign exchange market is a currency market, also known as forex or FX. It is a global marketplace that determines the exchange rate of every foreign currency across the world. Participants in this market can buy, sell, exchange, and speculate on the relative exchange rates of various currency pairs. Forex market is a marketplace where you can buy and sell the forex pairs. Now, what are the forex pairs? For example, I live in US and my home country is India. In this case, every time I want to send money to my home country, I want to remit money to my home country, I have to sell US dollars and buy INR, which is an Indian currency. In this case, every time I send money to my home country, banks give me some exchange rate, and on that exchange rate, I need to sell my US dollars and I need to buy my INR. In this case, I am buying INR and I'm selling US dollars, where sometimes the rate will be like 80, like $1 is equals to 80. In this case, the price of USD INR forex pair will be is equals to 80. Now, for example, after 10 minutes, the price of the same forex pair rise up and it went to 81. Then the price of USD INR will be equals to 81. So this is how the prices of currency pair changes. Now, if I would have bought at the price of 80 and I would have sold at a price of 81, in this case, I would have made money. I would have made 1 INR. Now, let's talk about third segment, which is a stock market. Now, a stock market referred to several exchanges in which stocks, shares of publicly listed companies are bought and sold. It means you can buy and sell the stock of several companies. For example, if you want to buy some shareholding in Netflix company, then you can go to US stock markets and then from there you can buy some shareholdings in Netflix. Same like other companies just like Tesla, Apple, Amazon, Facebook. Now it depends upon the company in which you want to buy the shareholding belongs to which country. So the share of that company will be there in that stock market only. For example, if you want to buy a share of Apple, so Apple is based in USA, so you will find the share of Apple in US stock markets. If you want to buy the shares of Tata Motors, Tata Motors is an Indian based company, so you will find the share of this company in Indian markets. If you want to buy shares of Deva, so Deva is a UAE based company, so you will find the share of Deva in UAE stock markets. So this is how a stock market works. Now let's come to our fourth segment, which is a index market. Now what is index market? Index market is a market where you can do buying and selling in index. Now what is index? Index is much related with the stock market. As I told you that in every country there are stock markets. In a country there can be one or more than one stock market. Now the index is the average of a stock market. So if you want to know what is happening in a complete stock market, the complete stock market is growing or it is falling. If you want to know that, then index is the best thing to evaluate. For example, in USA there is a stock market called Nasdaq. Now, if you want to know what is happening in Nasdaq stock market, so you can check the index of this Nasdaq stock market. And the name of the index of Nasdaq stock market is Nasdaq 100. And in this Nasdaq 100, it comprises of top 100 tech companies of USA. It means it is an average of top 100 technology companies in the USA. It means if most of the technology companies share prices will rise in USA out of these 100 companies, so the price of Nasdaq 100 will also rise. If most of the company share prices out of these 100 tech companies will fall, in this case the price of Nasdaq 100 will also fall. So what is happening in the overall market will be reflected in the index. Majorly, people use index market to make their long-term investments because index are known as very safe type of investment which may give you consistent returns. So every stock market have their own index, just like Nasdaq has their index called Nasdaq 100. Germany stock market, they have their index called DAX 30. S&P 500 is again an index in USA which comprises of top 500 large companies in USA. Then we have UK. UK's stock market index is UK 100. Then we have Dow Jones. It is again a stock market of USA. It comprises of top 30 industrial companies in USA. So this is how the index market works. Now let's talk about our next market, which is the last segment, and this is cryptocurrency market. A cryptocurrency market is a digital currency which is based on a blockchain technology and secured by the cryptography, which make it nearly impossible to counterfeit or double spend. Cryptocurrencies can be traded on a centralized or decentralized network. These cryptocurrencies are not regulated or not authorized by any government of any country till now. So that is why there is very high volatility into the prices of these cryptocurrencies. The cryptocurrencies are very new to the market and it's been only 10 to 12 years that these cryptocurrencies are there in the market. That is why you can also see the high volatility into the market of cryptocurrency. You can see some of the intense movements of the cryptocurrencies in the market. Sometimes you can see that there is a sharp rise in the price of Bitcoin, maybe Ethereum, and you can also spot a sharp fall in the prices of Bitcoin, Ethereum, and other cryptocurrencies. So this was all about the 5 major markets of the financial market. After knowing about all these type of markets, now the question arises, what exactly we have to do? We have to buy, we have to sell. If we have to buy, at which price we should buy, and if we have to sell, at which price we should sell. So all these questions arises in our mind. Now to get the answers of these questions, we need to do the study of the market. There are 2 approaches by which we can do the study of the market. Number 1 is fundamental analysis approach and number 2 is technical analysis approach. Now let's learn about both of these approaches one by one. First, we will talk about fundamental analysis. Fundamental analysis is a method of examining related economy and financial factors. Basically, the fundamental analysis is the study of the news and events in the market. So, when the market is derived by the news and the events in the market, it means the fundamentals are deriving the market. For example, when the COVID started, there was a COVID in the market, it means there will be a lockdown. When there is a lockdown, it means no one will move. When no one will move, no one need petrol, diesel, and no one need crude oil and Brent oil. So when there will be zero demand of crude oil and Brent oil, the prices will fall sharply. That is what happens after the fundamental news of lockdown appears in the market and the prices of crude oil and Brent oil started falling sharply. Again, when the lockdown started opening, again people started demanding petrol, diesel, crude oil and Brent oil. So in this case, again the prices of petrol and diesel and crude oil and Brent oil started rising because the demand was rising. So these newses of the market are affecting the demand and supply of the market, and the demand and supply is affecting the price of the market. This is how the fundamental analysis is affecting the prices in the market. So, if you will evaluate the news or the event, and on the basis of that, you are doing your study. That study is known as fundamental analysis. Now, fundamental analysis also have some cons. For example, in fundamental analysis, you do a study on newses and events, but the sources of newses and events which we have are very outdated. The news channels, news articles, and magazines, these all are outdated news sources. So, when we get the newses from these resources, it is always very late to get the entry in the market, which results in a wrong analysis of the market sometimes. So, to overcome with this problem, we'll focus more on the next type of analysis, which is a technical analysis. Now, what is technical analysis? Technical analysis is a trading discipline applied to assess investments and spot trading opportunities by analyzing historical trend gathered from trading activity such as price movement and volume. So, for example, in technical analysis, you are focusing on the price movement and you are coming to a conclusion that what are the expectations from the price in near future. For example, I have a water bottle and the price of this water bottle is $10. And if I'll ask you that can you make a guess what will be the price of the same water bottle tomorrow? Maybe you'll not be having any guess. But if I'll give you some historical data, if I will tell you the price of same water bottle day before yesterday was $8. The price yesterday was $9 and price today was $10. It means in market the price of the water bottle is increasing on daily basis, and second analysis says that it is increasing by $1 per day. So now if I will ask you to make a guess what is going to be the price tomorrow, so I think your first guess will be $11. Why? Because you analyze that from last 3 days the prices are increasing and it is increasing by $1 per day. So it means tomorrow there are higher expectations that the price may reach $11 per bottle. This is how the technical analysis works. This is very simple example of the technical analysis, but in a real technical analysis we are going to study on very huge data of the market. And these huge data are already available in the form of charts and graphs. So first of all, we will learn about how these charts are formed and how we can read these charts and how we will come to know that where the price was trading in last few hours, in last few minutes and days and years. Risk management is very important tool in the trading field. So let's understand the definition of risk management. In financial terminology, risk management is the process of identifying and assessing the risk and then developing the strategies to manage and minimize the same while maximizing the returns. Every investment demands the certain amount of risk, and for an investor to assume this risk, he has to be compensated duly. Ways to do the risk management. There are majorly 4 ways to do the risk management, where number 1 is risk and reward ratio, number 2 dollar cost averaging, number 3 diversification, and number 4 money management. In today's session we are going to focus primarily into risk and reward ratio, And by knowing risk and reward ratio, let's understand how we can minimize our losses and maximize our returns. Risk and reward ratio mark the prospective rewards an investor can earn from every dollar they risk on an investment. Many investors use risk reward ratio to compare the expected returns on an investment with the amount of risk they must undertake to earn these returns. Consider the following example: an investment with a risk reward ratio of 1:7 suggested that an investor is willing to risk $1 for the prospect of earning $7. Alternatively, a risk reward ratio of 1:3 signals that an investor should expect to invest $1 for the prospect of earning $3 on their investments. Traders often use this approach to plan which trade to take, and the ratio is calculated by dividing the amount of a trader stands to lose if the price of an asset moves in an unexpected direction by the amount of the profit the trader expects to have made when the positions are closed. In this risk reward ratio, before taking a trade, you finalize by yourself that while taking a trade, how much you are risking your capital in terms of how much you are willing to gain. So, for example, you are taking a trade. So, before taking a trade, according to your risk reward ratio, you are going to define it that if the trade will goes against you, in that case how much maximum amount you are ready to lose, and if the trade go with your direction, in that case how much you are willing to gain with the same trade. This is how the risk and reward ratio works. Now let's understand the probability of winning and losing the trades while having multiple trades. Now, I will give you an example of $1,000 account with a risk reward ratio of 1:1. So, if in $1,000 account you are always using 1:1 risk reward ratio, the probability of winning will be always 50% and the probability of losing will be 50% again. In this case scenario, if you will take n number of trades, for example, we assume we took 10 trades. So out of 10 trades, I'm assuming that 50% of my trades are going to close in profit and 50% of my trades are going to close in loss. So for example, in each trade I took a risk of $10 and in each trade I am willing to gain $10, which is risk reward 1:1. I'm gaining the same amount and I'm losing also the same amount. In this case, according to the probability, if you will take 10 times trades, so in that case 5 times you will lose and 5 times you will win. If you will do the total of the losing amount and the winning amount, you will see that you won $50 and you lose also $50. Which means if you are using 1:1 risk reward ratio, then your losses will be 0 and your profits will also be 0. Now let's talk about the accuracy in the trading. For example, now after learning technical analysis, after learning so many strategies of technical analysis, now you come to a point where you are getting 70% of the market accuracy. In the case of 70% market accuracy, it means out of 10 trades, your 7 trades are closed in profit and 3 trades are closed in loss. Here again, every time I'm losing, I'm just losing $10 and every time I'm winning $10. In this case, out of 10 trades, if I'll make loss in 3 trades, so I will lose $30, and out of 10 trades, in 7 trades, if I will win $70. So if I'll check overall, I win $40 in total. This is how the risk reward ratio and the accuracy will combinedly help you to do the risk management into your account. Now, if you will keep on changing your risk reward ratio, for example, in the first trade, your risk reward ratio is 1:1, but in second trade, your risk reward ratio is 2:1. This is a type of indisciplined trading. All you need to do is while trading, you have to stuck to the same risk reward ratio, because with the same risk reward ratio, you are going to be a disciplined trader, and it will be very easy for you to evaluate yourself that how much accurate your trades are going. So this is a simple example by which I explained you how the probability will help you to not to lose your all capital, and how the 1:1 risk reward ratio with some accuracy will help you growing your account size. This was a quick introduction about the different type of segments in the financial market and fundamental analysis and technical analysis. Now we are going to end the session. Before ending the session, I would like to tell you Zylostar is available on all the social media platforms. Just make sure you can join all our social media platforms, because from there you will get the market updates on time. Thank you so much and have a nice day.